Hello, we're here to talk about the growth and importance of Asian financial markets. And joining me to discuss this is Warren Hogan, Chief Economist of ANZ. Welcome, Warren.
Thank you.
So first of all, we hear a lot about the Asian century. What is it and what will it look like?
The best way to sort of characterise it is just to look at the structure of the world economy. Right now, about half the world economy is represented by the US and Europe, and just under a quarter is represented by Asia, including Japan and obviously the rest of emerging Asia. The Asian century, should it come to fruition, we run forecasts, and by 2050 that will be completely turned around. The US and Europe will be about 20% of the world economy, and Asia will be about half.
And the financial markets, are they as important already as the industrial production and this sort of thing?
The next stage of development cannot happen without a significant reform of the financial sector across the whole of Asia. That's obviously happening in China right now. Asia's financial markets are underdeveloped and quite heavily regulated with capital controls, etc. So for these countries, such as China, to become high-income, consumer-led economies, they must have open and efficient financial systems. So the Asian century cannot happen without a financial revolution, which we believe is underway but has a long way to go.
So you think the Chinese financial system is going to become twice the size of the US financial system by 2030 or 2050, I think? I mean, part of what's gone on in the last couple of years is this huge build-up of foreign exchange reserves in China and in other countries around Asia. How has this held back the markets and has it crowded out private savings?
Well, effectively, the surplus of Asia, and Asia is the big saving part of the world, has been recycled into the international system via these foreign exchange reserves because of heavily managed exchange rates, capital controls and the like. To take the next step, financial reform is essentially going to result in floating exchange rates, and that'll mean the Asian surplus will be recycled via the private sector rather than through the official sector, and that will generate significant opportunities for financial institutions. There'll be significant growth in the markets in Asia and a significant increase in two-way portfolio capital flows between Asia and the rest of the world, but most importantly within Asia.
One of the things that we've seen is most of these foreign exchange reserves have gone into government bonds and especially US treasuries. How will that change and what does that mean for the rest of the world?
The great bulk of flows out of foreign exchange reserves are to government bonds, to US treasuries. If they are no longer building and the private sector's role is taken up to allocate those savings, then you'll see a much more even distribution of money flowing into different asset classes. So you'll see a lot less money flowing into treasuries, more money into equities around the world, and obviously foreign direct investment out of Asia, particularly out of China, is going to pick up substantially.
And so, I mean, that's going to have big knock-on effects for the cost of financing for the US economy as much as anything else, right?
As these changes work their way through the system over the next 5 to 10 years, the US cost of capital will normalise, it'll go back to what it should given its underlying economic fundamentals. And of course, the really important element of this is that the cost of capital for many emerging economies will decline, particularly in Southeast Asia, but across the whole emerging world.
So to turn Asian economies from very kind of government-driven and banking-driven and economies where there's a lot of foreign exchange reserves building up at central banks into something with much more sophisticated and functioning private markets and financial institutions is going to take an awful lot of reform and changes in these economies. You're not being a bit too optimistic that that's going to happen?
Yeah, well, the report is essentially optimistic in the sense that it assumes this happens. We're seeing it happen right now in China, and there's great motivation to do it. China's financial system right now is unable to cope with the sophistication of its underlying economy. So there is a reason to do it. I think a lot of these governments understand also that the next stage of their development, to move into a high-income sort of status as a country, requires sophisticated financial systems where markets and market prices play the role in allocating capital. There will be resistance, vested interests will be under pressure, and of course there is the potential for mistakes to be made, which will create caution in politicians. So we're optimistic by definition in the report, but I'm also optimistic that the Asian leadership from China all the way through Southeast Asia is aware of the opportunity and has learnt from history that there's many countries that haven't taken the steps to reform their economies. And of course, this is part of a broader reform process. It's not just about financial reform, it's about economic reform.
Warren Hogan, thank you very much.
Thank you.